Hey everyone, and welcome back to the channel. Here in our amazing city, we deal with rupees every day. But have you ever stopped to think about why one Indian rupee is worth a certain amount in US dollars, euros, or any other currency? And more importantly, does the value of our rupee, or any country's currency, truly reflect how well our economy is doing? That's exactly what we're diving into today. It's a fascinating question with a not-so-simple answer. Let's explore whether a strong or weak currency is a reliable indicator of a country's economic growth. First things first, how is the value of a currency determined? Like most things in economics, it boils down to supply and demand in the foreign exchange market. If there's a high demand for Indian rupees, perhaps because many international businesses want to invest in India, or they want to buy Indian goods and services, then the value of the rupee tends to go up. Conversely, if there's a high supply of rupees and less demand, its value can decrease. Factors influencing this demand and supply include trade balance. If India exports more than it imports, there's generally higher demand for rupees to pay for those exports. Foreign investment. When foreign companies invest in India, they need to convert their currency into rupees, increasing demand. Economic growth expectations. If investors believe India's economy will grow strongly, they're more likely to invest, increasing demand for the rupee. Government policies and stability. Stable and business-friendly policies can increase confidence and attract foreign capital. So, a strong currency can sometimes be a sign that a country is doing well economically, attracting investment, and has strong export potential. Now, here's where it gets interesting. The idea that a strong currency always equals a strong economy is a bit of a myth. A perfect example of this is Japan. The Japanese yen is considered a very strong and stable currency, often seen as a safe haven in times of global uncertainty. Yet, for the past few decades, Japan's economy has struggled with very slow growth. This shows that a strong currency doesn't automatically translate to a booming economy. A very strong rupee can actually make Indian exports more expensive for buyers in other countries. If a US company wants to buy software from a Bengaluru-based firm, a stronger rupee means they'll have to pay more dollars for the same service. This can hurt our export competitiveness and potentially slow down economic growth in export-oriented sectors. On the other hand, a strong currency makes imports cheaper. This can benefit consumers and industries that rely on imported raw materials. So, a strong currency has both pros and cons. True economic growth is a much broader concept than just the value of its currency. It's about increased production. Are Indian businesses producing more goods and services? Job creation. Are more people finding employment? Improved living standards. Are the lives of average Indians getting better? Innovation and development. Is the country fostering new technologies and industries? A country can have strong economic growth even with a relatively stable or moderately valued currency. In fact, some countries might strategically manage their currency value to support their export sector and overall growth. Think about countries that heavily rely on exports, like China. For many years, China intentionally kept the value of its currency, the yuan, relatively low. This made Chinese goods cheaper and more attractive in the global market, which helped fuel its massive export-driven economic growth. So, where does India fit into all of this? As a rapidly growing economy, India needs a competitive edge in the global market. While a very strong rupee might sound good on the surface, it could hinder our Make in India initiatives and make it tougher for our manufacturers and service providers to compete internationally. The Reserve Bank of India, RBI, often plays a role in managing the rupee's volatility to ensure stability and support economic growth, keeping in mind the needs of both exporters and importers. A steadily growing GDP, increasing investment, both domestic and foreign, and the thriving domestic market are far more reliable indicators of India's economic progress than just the exchange rate against another currency. To wrap it up, while currency value can offer some insights into a country's economic standing and the forces of global supply and demand, it's not the sole or even the most accurate reflection of its economic growth. Focus on the fundamental drivers of growth: production, employment, innovation, and overall improvement in the lives of the people. These are the true signs of a nation on the rise. A deeper dive: how central banks influence currency value. Countries like the RBI decide the currency value. That's a great question, and the answer is subtle but important. In a free market, a central bank doesn't decide the currency's value in a command and control way. It uses powerful tools to influence or manage the value. Think of it less like setting a price and more like a ship captain steering a vessel through powerful ocean currents. Here's how they do it. Interest rates. By raising interest rates, the RBI makes it more attractive for foreign investors to bring their money into India to earn a better return. This increased demand for rupees in the global market naturally pushes the value of the rupee up. Foreign exchange intervention. The RBI can directly intervene in the foreign exchange (forex) market. If the rupee's value is falling too quickly, the RBI can use its reserves of foreign currency, like US dollars, to buy rupees, which creates artificial demand and helps to stabilize its value. The unique case of China's system seems different. That's because it operates under a managed float system, which gives the government a much firmer grip on the yuan's value. Daily reference rate. The People's Bank of China, PBOC, sets a daily central parity rate for the yuan against the US dollar. The yuan is then only allowed to trade within a very narrow band, currently plus 2%, around that rate. Heavy intervention. The PBOC intervenes frequently, buying or selling vast amounts of foreign currency to keep the yuan within its desired band. Strict capital controls. China has strict rules on how much money can flow in and out of the country. This prevents large-scale speculation against the yuan, giving the government more control. The reason for this is strategic. It helps keep their exports competitive. So, while it's not a complete decision, China's government has a far greater say in its currency's value than countries with free-floating currencies. What are your thoughts on this? Let me know in the comments below.